Welcome back. In the previous chapter, we covered dealing with uncertain payoffs in perfect capital markets. It turns out that this is pretty much as far as most of the theories and models of modern finance go. They're almost all perfect capital market based theories. Sometimes this seems appropriate, sometimes not. We'll cover these problems in chapters 11 and 12. For the next 3 chapters, we'll stay in this beautiful world, perfect capital markets, and analyze rates of returns to investors, retail and otherwise. So in this video and chapter, I want to give you a taste of what it is that we want to explain. I want to give you a taste of the basic financial facts of life. How much have different investments paid off in the past? So what I'm going to do is we're going to talk about basic historical return patterns. We're going to talk about what risk aversion does, how to measure risk and reward, benchmarking. We're going to talk about the capital asset pricing model, its formula and its inputs, how to use it. And then I'm going to tell you why it actually doesn't work so well. For convenience, we often use large diversified portfolio to represent a swath of investment types. It's admittedly inaccurately so because each of these has many subclasses and you can throw them in different weights, but roughly speaking, they give you an idea of how, say, stocks perform. So stocks is our first asset class, and there are subclasses like large firm stocks, small firm stocks, foreign stocks, value stocks. Then there's another class called bonds, and those contain things like long-term bonds, risky bonds, foreign bonds, mortgage bonds, and we sometimes for each of these see a large firm stock portfolio. How did that do? Or how did a risky bond portfolio do? There's also things like cash, and by cash we don't mean dollar bills in a drawer. What we mean is really very, very short-term investment instruments. So that could be a money market fund, that could be a bank account, foreign currencies, some short-term bonds, different things, just short-term fixed income. Then we have real estate as an asset class. So you can have a commercial real estate portfolio or a portfolio that has just retail or a real estate portfolio that's just on the West Coast or in some foreign countries. Art has also been described sometimes as an investment class. And there again, you can think about investing in paintings or just Renaissance paintings or Renaissance sculptures or books. And at some point, people actually were excited about non-fungible tokens. That I think has worn off, but that was a crazy class all to begin with. Then there's things like commodities. So you can actually buy eggs, bacon, various other things like that. Now, you don't buy the eggs and the bacon and you store that in your refrigerator. What you actually do is you buy instruments that give you a claim on eggs and bacon, and you can buy and hold this. There's also crude oil. A lot of people speculate in petroleum. Then there is gold, silver, platinum, precious metals. Again, there's whole asset portfolios of this, and that's its own asset class. And then there are other things, agricultural, like agricultural land. You can invest in agricultural land. You can also invest in grains. Now, the most important one from our perspective is the overall stock market. And there is many different stock market indexes. But the most important one is the S&P 500. So the S&P 500, roughly speaking, are the 500 largest companies. You take their portfolio, you roughly evaluate it. So you have a lot more in, say, Apple, one of our largest companies, than in, say, a stock that's number 400. You put them all together, you get the S&P 500, and we're interested in what the rate of return on this was. The S&P 500 is often considered sort of like the stock market overall. It's sort of an overall index that is. Now, the S&P 500 index value that you see on TV every day does not include dividends. It's a bit of a problem because the S&P 500 stocks pay quite a significant amount of dividends. And right now, it's order of magnitude about 2% per year of the value. So if you really want to get the rate of return on the asset class market and use the S&P 500 for that, you need a source that gives you the total returns on the S&P 500, and I've put one of those websites on there, but there's many other ones that will give this to you as well. Now, here I've put for you the total rate of return on the S&P 500 in different years. So in 1970, it was 3.5%. In 1971, it was 14.1%. In 1976, it was 23.6%. And you can already see that it's actually been quite a tremendous time period for stocks. I only see 5 negatives, and everything else has been quite positive. So it really was an amazing run for stocks since about the 1980s. Here it continues to 2000. And again, we have a few years which were really bad years, like 2001 and 2002. That was the end of the tech bubble and a recession. Then we have the financial crisis of 2008, where you would have lost about a third of your money. Then we have a little bit bad in 2016, not particularly bad. And another one, not in the COVID crisis, but 2 years after the COVID crisis in 2022. But overall, again, there is a lot of very positive rates of returns in many different years. Now, if I try and give you a measure of the risk and reward, I've got a little bit of a problem because depending on what time period I'm going to use, I'm going to get different numbers. We are going to use mostly 2005 to 2024, and that is more for illustration's sake. Usually I would do a much longer time period. This will be good enough for this presentation, and it gives you a good flavor because the returns were roughly representative of what actually happened over longer time periods too. So here are my stock returns, time series thereof. Each year is a bar. When the bar is below 0, of course, you lost money. The red line with the 2 arrows over there is the mean. So we had a mean. We also can draw the histogram, and that's some version of a histogram. It's called a density plot, which is a little bit less sensitive to how you draw the bars. And I can show you also the compound rate of return. As you already know, the arithmetic and the geometric rate of returns are quite different and can be quite different. The gray bar here, incidentally, is inflation. So if you had invested in stocks beginning in 2005, well, just after 2009, you would have been in the red, but if you had just continued holding, today you would have some number, just judging from the graph, about $8. And since it's so hard to graph, let's try and have me describe it with numbers. So if you had invested $1 in January 2005, you would have ended up with $7.15 in December 2024, not $8. But you know, more accuracy is really quite useless. If I choose a slightly different stock market portfolio sample period, I would get different rates of return. Now, if I wanted to find out the geometric average rate of return, I would just use the formula there. We have a particular number of years, and it comes out to be about 10% per year. The arithmetic average rate of return is higher than this. It's 11.9%. That is always the case. The arithmetic average rate of return is higher than the geometric average rate of return. And finally, the standard deviation of your rate of return, which you can think of as the risk of your portfolio, was about 17% per year. Now, stock market was great from 2005 to 2024. There were ever larger inflows, lots of them coming in from abroad. There was the Great Recession, there was COVID, but they all turned out to be hiccups in the scheme of things. They weren't drastic. It was not like the world was coming to an end. The big question, of course, is, will this average rate of return that we've got here, which is about 12% arithmetic, 10% geometric, will that continue in the future? If it did, if I had real great confidence, it of course would be a great idea to continue sticking to stocks. You would just buy and hold it over the long term, 20, 30 years. You would do incredibly well. I would love to do it. Unfortunately, I cannot guarantee to you the 10 or the 12%. Now, let's compare this to another class. Another class are US long-term treasury bonds, which we already looked at in an earlier chapter from 2005 to 2024. Now there's a term premium in there because these are the longer term ones, but there is no default premium here and no risk premium. This is how the time series looks like. And it's the same scale as what we had before. And you can already see that the red line, which is the mean, is lower. You still had a good number of negative years, but they weren't as negative as the stocks were. This is the histogram. And this is what you would have ended up compounded. So if you just bought it in 2005, rolled it over, held it every year, you would have ended up with only about $2. Now in 2020, you were still much better ahead. You were more like $3, $4, but the last 4 years were really not very good to treasury bonds. You can compute the same numbers as before. So $1 became $2. The geometric rate of return was 3.3% per year. The arithmetic average rate of return was 4.3% a year. And the standard deviation was actually remarkably high for these particular bonds. Now, there's one more thing here. The treasury bonds in the real world actually didn't pay off as well as stocks because the interest is taxed every year unlike the capital gains. So you would have actually ended up even worse relative to stocks. So over this sample period, no question, you would have much preferred stocks over treasury bonds. Cash. So cash is, in this case, short-term treasury bonds, not very long, 90 days, 1 year. They're definitely risk and term premium free all around. Let's see how they did. Well, if you just look at the bars, you didn't lose money basically in any year, but the returns are also all very, very tiny, as you would expect them to be. The histogram is very tight, and every $1 you would have ended up with $1.27. Your geometric and your arithmetic rate of return were 1.4% each. The standard deviation of your rate of return was very, very small, which is why the geometric and the arithmetic rate of return are very, very similar. Now, which of these asset classes and stocks, including stocks, generally offer higher average rates of return? Pause.
Please pause this video now, answer the question on a piece of paper, and then continue.
Okay, in this sample, stocks did best, bonds were next best, and cash was least best. Which of these asset classes were riskier?
Please pause this video now, answer the question on a piece of paper, and then continue.
Stocks were the riskiest, bonds were less risky, and cash least risky. Cash were almost risk-free. They had variation, but they really were risk-free. Was there a risk-return relationship in the United States?
Please pause this video now, answer the question on a piece of paper, and then continue.
At least in broad strokes here, yes. So this also extended to longer samples as well. So it's not just an artifact of this small sample period, this was hold. So here is the table, just summarizing everything that we had before. Stocks had the highest rate of return and the highest risk. Bonds, in this case, had lower average rates of returns and still fairly high risk. Bills were almost risk-free. Now, if we did a longer sample, bonds actually did a little bit better and had smaller risk. So they would usually sit more about halfway between stocks and bills. There's something called the equity premium, which is the difference between stocks and risk-free securities. Sometimes people use the arithmetic average, sometimes the geometric average. Sometimes they use bonds and bills for the risk-free, but order of magnitude, just looking at these numbers here, the equity premium was way above about 6% per year. Now, this is far larger than the implied cost of capital estimate that we had in Chapter 4, which only was about 2 or 3%. Does this mean that stocks will outperform U.S. Treasuries in the future?
Please pause this video now, answer the question on a piece of paper, and then continue.
We presume they will, but we're not sure. So we may not only draw bad outcomes and risky aspects, but the whole history of stocks and the whole history of treasury bonds may not even be indicative of what's going to happen in the future. There may be totally different distributions, and even the past distribution may just have been lucky draws. This may not even have been indicative of the expected rate of return before the fact. Does this mean that stocks will be riskier than U.S. Treasuries?
Please pause this video now, answer the question on a piece of paper, and then continue.
Now, we are more comfortable, we are more confident to think that they're going to continue being riskier. We're not 100% sure either, but on this one, I would be willing to bet a good amount of money that this will actually continue to be true. Whereas in the previous slide, when I asked about will stocks outperform treasury bonds, say over the next 10, 20 years, I think they will, but I am not that sure about that. So there I'd be much more hesitant. Now, financial statisticians use the historical distribution, the means, the standard deviations, etc., to stand in for what we believe the future will hold. When we threw the die, we knew the physics of the die. So we didn't need history. We knew that a fair die should have 1/6 probabilities each. Here, we don't know the physical process. So we have to guess what the physical process is. And we really don't know the dynamics of the financial markets. So all we can do is extrapolate from historical data. This data is very useful. It's very helpful, but it can also mislead if it's not used carefully. So correlations, variances, standard deviations, they're quite stable. They're quite reliable, especially if you use daily data. The means, like the average rates of returns, are very, very unstable for anything except perhaps very broad asset classes. But again, I'm not so sure how the stock market is going to do over the next 20, 30 years. It's even harder to estimate tail risk. So if I asked you, what is the probability that the stock market will drop 90%? I've never observed such a thing. Is it possible? Yes, it is quite possible. Am I very good in assessing what the probability is that this is going to happen? Is it 0.1% or 0.001%? I don't know. I really have nothing but philosophy to offer you. It is very, very difficult to estimate. So tail risk, we don't know very much. The only reason why we use historical data is because the alternative is no data, and that would be way worse. So, if we are interested in extrapolating expected, say, 5-year, 10-year rates of return, we typically do this with historical 5, 10 years geometric returns. What people very often do as an error is they just take the monthly or the annual numbers, and then they multiply this, and then they think, well, this is representative of the future. But it's not, because of the difference between geometric and arithmetic rates of returns. That is, the difference between average rates of returns and buy and hold rates of returns, cumulative and compounded. Now, in the book, there is a variety of individual stocks as well, and they're also plotted, so you see the same kinds of plots that I just showed you before. For example, Tesla. Tesla has been public since 2010 for about 15 years, so I couldn't do it from 2005. If you had invested $1 in Tesla when it went public, you would have had 2 weeks ago $254. It's like you put money in the lottery and you won 5 or 6 right numbers in the lottery. This is incredibly good. It's like Bitcoin, which really was worth nothing and now is worth almost $100,000. Since then, actually now that I'm recording this, Tesla has actually already lost about 30-40% of its market cap. So right now it's already back to 160 again. However, if I had just stood there 2 weeks ago and I would have calculated what was the arithmetic rate of return, well, Tesla almost doubled its money every year. Its geometric rate of return compounded was 30% per year. And of course, it had huge standard deviation of the rate of return. Standing there 2 weeks ago, or even today, do I believe that Tesla is going to double in value every year forward looking? Of course not. I'd be crazy. Intel Corp is another company that looked really, really good for many, many decades. But if I had invested $1 in 2005, all I would have been left with was about $1.50. I had very, very low geometric rate of return, not much more than risk-free cash. The arithmetic rate of return was higher, and the difference between those two is huge because the standard deviation of the rate of return, again, is very large. General Motors. If you had invested in General Motors in 2005, you would have lost all your money. General Motors went bankrupt in the Great Recession. The existing shareholders got zip, nada. Today's shareholders, even though they have the same ticker, are completely different people. They bought at an IPO and they then changed the name back again. So your geometric rate of return was minus 100%, even though your arithmetic rate of return was not minus 100%. Huge standard deviation. So could you have lost your shirt in individual stocks?
Please pause this video now, answer the question on a piece of paper, and then continue.
Of course, not only your shirt, your pants as well. Could you have lost your shirt in asset classes?
Please pause this video now, answer the question on a piece of paper, and then continue.
Not in the United States, although some asset classes lost money for many, many decades. Now, in other countries, there were markets in which you would have lost all your money. The entire country collapsed. Not that rare in World War II. A lot of different countries collapsed, a lot of different stock markets collapsed, and the people that were invested in this had nothing left. So this gives you an idea of the various asset classes. Now I want to finish with a variety of random questions that are still important when you think about your own stock portfolio. Do you always earn money, that is, a positive holding rate of return, on assets with a positive arithmetic average rate of return?
Please pause this video now, answer the question on a piece of paper, and then continue.
Absolutely not. Think of a stock that has a rate of return of plus 100%, plus 100%, minus 100%. The final minus 100% means you lose all your money. And yet, the average rate of return here was 100, 100, minus 100. So it's 100 in total divided by 3 would have been 33%. Your average rate of return would have been 33%, and you would have lost all your money. So your average rate of return is not necessarily at all indicative of how you did in a particular investment class or asset. Is the average rate of return on an investment a good representation of the long-run rate of return that a buy and hold investor receives?
Please pause this video now, answer the question on a piece of paper, and then continue.
No, absolutely not. The particular arithmetic one corresponds to an investment strategy if you rebalance every year back to the same amount. But frankly, nobody does this. It's really not an investment strategy to think about the arithmetic rate of return. The thing you really are interested in is the compound rate of return. Now, let's assume that you're not risk averse, you're completely risk neutral, and you've got two funds, A and B, and they have equal arithmetic rates of returns. Now, A had a higher standard deviation than B. Did both investments earn you the same amount of money? That is, leave you with the same dollars?
Please pause this video now, answer the question on a piece of paper, and then continue.
This is often the case when you compare funds. So for example, you may compare a bond fund to a stock fund. And if the bond fund has roughly the same rate of return as the stock fund, because those funds typically quote the arithmetic rate of return, it's the bond fund that would have delivered higher compound returns, more money than the stock fund. You cannot easily compare funds that have different volatilities based on arithmetic rates of return. Can one translate the geometric average rates of returns to an arithmetic average rate of return, or vice versa?
Please pause this video now, answer the question on a piece of paper, and then continue.
Generally, no. There is an approximation formula, but even that only works for movements that are not too extremes. So your mileage may vary on this one. And here's the approximation formula. The geometric rate of return is the arithmetic rate of return minus the variance squared divided by 2. Not the standard deviation squared, the variance squared, which is a very rare thing to do. So here, for example, for stocks, we had an arithmetic rate of return of about 12%, a variance of about 17%. The approximation formula tells me the geometric rate of return should have been about 10.6%. And wow, we just got very, very lucky here. Sometimes it's better to be lucky than smart. That was right on the money. Would have been a terrible approximation in many other cases, like for General Motors. But if you really don't have any other numbers, you only know the variance and the arithmetic rate of return, and you have a hunch that it wasn't that extreme, this is an approximation formula you can use. Now, let me switch gears again. I want us to look at how a few investments have moved together, not just by themselves, as I did until now, but together. So on the following graphs, the x-axis will always be the rate of return on VFIAX. That is a fund that does nothing but hold the S&P 500. It's a very low-cost index fund by a provider named Vanguard. On the y-axis, I'm going to use different investment assets. And in each of these, a point is going to be 1 year, that is the rate of return on the index fund and the rate of return on another investment assets. The blue line is going to be the best relation, and the black dotted line is the 45-degree line. So here is my first graph. On the y-axis, I've got Ford, the rate of return on Ford, and on the x-axis, as I say, I have the S&P 500. Now, take a look at this graph for a little bit. It's really quite remarkable because in 2009, that is just after the Great Recession, when it became clear that Ford was not going to go bankrupt like General Motors, its stock went up by a factor of more than 3. It had a tremendous rate of return. Other than that, though, you can see that the rates of return on Ford sort of line up with the rates of return on the S&P 500. Now, let's take a look at a portfolio rather than just an individual stock like Ford. So I'm going to take a Vanguard fund that does nothing but hold tech stocks. And I'm going to try and compare that to the S&P 500. And if you look at this, the blue line, the best fitting line between them, has a slope that's greater than 1. It's a little bit steeper. So we had particular years like 2009 in which the S&P 500 went up by about 30% and technology stocks went up by about 60%. Similarly, in 2022, the S&P 500 went down by about 20% and the tech stocks went down by about 30%. So whenever the S&P 500 moved a little bit more, the tech one moved even more. How about utility stocks? So if you look at the utility stocks, that's actually a much flatter slope. So whenever the S&P 500 moved, the utility stocks moved less. They still moved in the same direction, roughly the same direction, but not as bad as the overall S&P 500. For example, you can see that in 2022, the S&P 500 lost about 20% of its value, and utility stocks barely budged. What about gold? So gold is an investment asset. You can buy different securities that are primarily just holding gold. And when we try and fit the best line there, gold is not very sensitive to what happens in the stock market. So in 2008, during the financial crisis, even though the stock market went down tremendously, gold actually had a positive rate of return. Conversely, when the S&P 500 did really well in 2013, gold lost a lot of money. What about treasury bonds? We already know that treasury bonds are risky. So what we have here is actually a slight negative association. It was not always like this. So sometimes it's a little bit positive, sometimes it's a little bit negative. But overall, the association of treasuries with the stock market is fairly mild. Again, a lot of it is driven by 2008, the financial crisis, when the S&P 500 went down tremendously, lost 30-40% of its values. The treasuries actually went up. They gained more than 20%. During the financial crisis, a lot of investors wanted to pull their money from stocks into bonds, and especially government bonds. Now, finance has a lot of data. That's a big advantage over other economic fields. But we have to be careful about the data because even though it tells us a lot about these things, maybe history is not representative of the future. And the future is really all that we care about. We only use history because we want to judge the future. We're not historians per se. That doesn't interest us as much. Really, can we trust history to tell us something about the future? When I look at stocks or funds or different kinds of stocks, they typically move together, but not perfectly so. It's very, very likely that this will continue. So things like covariation, correlations, betas, which is really the slope of this blue line, those tend to be incredibly stable over long horizons, even over 5 to 10 years, certainly over the next year or two, which is all that we are really interested in investing. So it gives me a good idea about where I'm going to have non-synchronicity, where something is very exposed to market risk and something is not exposed to market risk. So I'm pretty confident that long-term treasuries are not very sensitive to movements in the stock market. Same thing for gold. So later on in this class, we're going to exploit this non-synchronicity, the fact that not all assets move together, for diversifying our own portfolios. That's it for this video and for the basic history of rates of returns. In the next video, I'll talk briefly about market institutions. See you soon. Bis bald.
I have a report on the stock market for you.
Okay.
Helium was up, feathers were down.
Very funny.
Paper was stationary.
Any more?
Knives were up sharply.
Really?
Elevators rose while escalators continued their slow decline.
Okay, I get it.
Diapers remained unchanged.
Mercy, enough already.
Toilet paper touched the new bottom.
I'm leaving.
Balloon prices were inflated.
Goodbye.
Hey, the market for raisins dried up. Pencils lost a few points. Hiking equipment was trailing. Weights were up in heavy trading. Mining equipment hit rock bottom. Hey, where are you going?